Hello, Baker International Finance students. We are now in week 3, and as you know, this course moves so quickly, so just stay on top of things. Really jump in early, those forum discussions, reply to your peers early, ask questions early if you have any questions. But after week 3, we're halfway done with the course. So we'll kind of continue with this, doing a series of 3 chapters a week, and then the last week it's just 2 chapters. But just stay on top of the quizzes, stay on top of your homework and the forum discussion posts, and you'll do fine. I want to give you a quick overview of this week. We covered chapters 7, 8, and 9. We look at chapter 7 first, foreign currency derivatives, futures, and options. First discusses the possibility of using futures. And with futures, what you're really doing is you're making a bet. As long as you have some underlying asset, in this case, if it's whether it's a currency, futures are also used. Say if you're a farmer and wanting to make sure that you protect yourself from the price of wheat going down in the future, there's different hedging techniques that you can use. So there are persons or people that use futures contract purely for speculation. We actually have speculators that are in the market that help provide liquidity to that market. But for the purpose of the multinational enterprise, really they would be using futures to help hedge themselves. For example, if they're worried about the price of the euro going up 6 months from now and they have to pay something in euros, what they're going to do is they're going to take out a futures contract, and they're basically going to go what they would call go long, betting that the price would go up. So that way, if it does go up and they owe euros in the future, they still have to pay that higher euro price, but they will gain from that transaction because they bet correctly. If they bet wrong and the price actually goes down, well, they get the benefit of buying at the lower price for the euros, but they're still going to have to offset the loss with the futures contract. So otherwise, if you don't do anything at all, you're totally exposed to fluctuations. And when I was at Sprint, when I worked there in the corporate headquarters, basically if it was under $250,000, we didn't do any hedging at all. We just kind of played the spot market. Whatever happened, happened. But if anything was larger than that, we'd engage some type of a hedge to make sure that we were protected. So a little bit more with that is just point out, if you go long, you're betting that the price goes up. If you go short, you're betting that the price goes down. Again, it's the importance of having the underlying security that you're working with. This one we're looking particular in currencies that we're looking at. And then also, that each day you have to deposit. When you start a futures contract, you have a margin that's a deposit. And what they will do is do it mark to market. So daily, depending on the price swings of the spot market, if it moves in your favor, they'll add money to your account. If it moves out of your favor, they'll take money out of your account. And if you get to one point, a level that you get too low, they have a margin call and they'll ask you to add more money to the account. The other area is with options. And with options, there's the writer of the option, there's the buyer of the option. Let's go back to our European euro example. If I have to buy euros 6 months from now, and let's say the euro is going for $1.20, I might have the right to buy it for $1.25 6 months from now. And if the price stays at $1.20, I'm not going to exercise that option. But if it goes up to $1.35, I look smart because now I can buy it at that $1.25 price and everybody else is paying $1.35. So the writer of the option does take some risk, but he's hoping that the one that buys that contract is not going to cash in on that contract. Think of it as kind of almost like insurance. Like, most of us buy house insurance to protect against a fire or home. We pay for that every year, but the likelihood of us ever cashing in on that is very slim. But if it did happen, we're protected and we're saved. But with the options, there's two basic types. The call is an option to buy at a certain price. Put is the option to sell. Like a wheat farmer would use a put because he wants to make sure they can sell his wheat as predetermined price well into the future. And if the price goes up in the market, he's going to take advantage of that. But if it drops significantly, he's going to exercise that put and sell it at that price. Okay. With that, Chapter 8, I want to talk a little bit about the interest rate risk and swaps. It talks about London, interbank offering rate, LIBOR. There's a lot of other different offering rates out there now. But the reason we care as a multinational enterprise, a lot of enterprises look at what's called a treasury yield curve, and they look at interest rate cost and what is their cost relative to the risk-free rate or the treasury rate. But obviously, there's credit risk. that how we are viewed in the market. You know, if a company like GE right now that's struggling is going to be viewed less favorably than a very strong company like Apple, so that can actually increase borrowing costs. And there's also repricing risk. So if they have a loan that matures in 5 years or a bond that matures, they have to go out and raise more capital. It may be at a higher interest rate because the market has changed too. So with that, just some other things to think about that with we want to protect ourselves from these fluctuations with changes in the cost of debt. So they give examples like interest rates, futures and possibility, forward rate agreements. In particular, the read can get a little technical, but go through the charts and the examples, and they talk about like a interest rate swap. So eventually, you know, most firms, if they're concerned about a floating interest rate like LIBOR going up in the future, they may be willing to do a deal where they're going to swap out some floating rate for a fixed rate. So the counterparty, like they use the example like the Bank of New York, I think, in the textbook, that they would be willing to pay for that LIBOR rate that is floating, and then you would pay a fixed rate back to the bank. But as they point out, they're not going to pay that credit difference because that's determined by market rates. They know that the LIBOR, that's somewhat controlled. How people are viewed or how companies are viewed in the market because their creditworthiness can change all the time. They don't want to deal with that risk. So it's another way that firms can have an alternative to having to go out and refinance and get additional capital because that can be quite expensive. Last thing, just to wrap up this week, in Chapter 9 talks about FX rate determination or foreign exchange rate determination. A lot of controversy here because it deals with theory, and the theory, if you kind of go through the chapter, there's really no clear answer about which theory is right. They even go so far as admitting that there are firms that use technical analysis. A lot of what we preach and teach in academia is all about fundamental analysis. You know, what's the true value based on information? Technical analysis looks at charting and paths and turns, and there's no underlying reason why the currency or asset is changing price. It's just saying it's just looking at trends and trying to predict patterns. And most in academia and finance would say that that's baloney. You can't predict things in the future. But we're also making, I should say, predict things in the future based on the past or trends or anything like that, or reading into the data and the numbers. It should be really based on other fundamentals that are out there in the market. But because so many people do it, we have to recognize it in the finance field. So with that, just to kind of wrap up again, they point out that it's still very difficult to predict financial exchange markets. There's no solid theory. And also, you know, that there's been problems in the past. They give the examples with the Asian crisis in '97, the Argentinian crisis, 2002. So intervention in markets by governments or by banks may not have the best decision, and trying to predict what's going to happen is difficult too. So that was it for this week. I did post some other Khan Academy videos out there if you're interested in watching them. I think they do a good job, or Khan does a good job of explaining some of those things in more detail. But otherwise, I will look forward to talking to you online. Take care.